Imagine waking up to find Bitcoin up 30%. Everywhere you turn, people are buzzing about it. Your coworkers, your friends, and even YouTube seems flooded with Bitcoin content. Then, you hear something intriguing. You can buy an ETF instead of Bitcoin directly. This sounds easy, right? No crypto wallets, no private keys, just log into your brokerage account. Click buy, and you have Bitcoin exposure. But here's the catch: the term ETF can mislead you about its safety. Bitcoin still carries the same risks. Today, we explore a bigger question: how does a Bitcoin ETF work? Why are investors drawn to them? What's the difference between owning Bitcoin and a Bitcoin ETF? What are the hidden fees and risks? And importantly, should a Bitcoin ETF be part of your long-term investment strategy? Let's dive in. For years, Bitcoin floated in a gray area. Some hailed it as the money of the future, others dismissed it as speculation. Then, something shifted. Bitcoin transitioned from exchanges to traditional finance. Financial companies started creating recognizable products for everyday investors. The conversation changed. Imagine telling someone, buy Bitcoin and manage your wallet, versus, log in to your brokerage and buy an ETF. The latter feels familiar. It's a bridge between traditional finance and cryptocurrency. So, what exactly is a Bitcoin ETF? A simple definition: an ETF is an exchange-traded fund. Instead of owning an asset directly, you buy shares in a product designed to give you exposure to that asset. Think about gold. You could buy gold coins or buy a product tracking gold prices. Bitcoin ETFs follow this concept. You buy shares of a product designed to track Bitcoin. Some track actual Bitcoin, others involve futures contracts. Spot Bitcoin ETFs are the ones holding actual Bitcoin. In January 2024, regulators approved the trading of these spot Bitcoin products. This marked a major shift, making Bitcoin more accessible through traditional finance. But why choose a Bitcoin ETF over owning Bitcoin directly? Let's envision two investors. Investor 1 owns Bitcoin directly. They manage wallets, private keys, and security. They are responsible for protecting their investment. Investor 2 buys a Bitcoin ETF. Their investment appears in their portfolio without managing the underlying Bitcoin. For traditional investors, this can be a simple entry point. However, there's a trade-off. With an ETF, you don't enjoy the direct ownership benefits. You rely on the fund's structure and custody. Bitcoin means you own it outright, while an ETF gives you market exposure through a financial product. Here's a common misconception. Investors hear ETF and think diversified or safe. But an ETF is merely a structure. It doesn't guarantee what's inside. A Bitcoin ETF offers concentrated exposure to a volatile asset. If Bitcoin drops significantly, your ETF likely will too. Remember, an ETF can make it easier to own Bitcoin but doesn't reduce its volatility. So, why the growing interest in Bitcoin ETFs? Imagine you're an investor familiar with traditional accounts. Someone tells you about Bitcoin exposure without needing extra infrastructure. This is powerful. Investments should be accessible. The more complicated, the fewer investors will engage. Bitcoin ETFs simplify access. They reach beyond crypto enthusiasts to traditional, retirement, and institutional investors. That's a massive market shift. Now, let's discuss Canadian investors. Canada took early steps, launching Bitcoin ETFs in 2021. These products may fit into registered accounts like TFSAs. This can have major financial implications, as holding an investment in a tax-advantaged account can affect outcomes. When considering what Bitcoin ETF to buy, ask, which account should I hold it in? Always check eligibility for specific ETFs and accounts. Next up, fees. Though not as thrilling as Bitcoin's price, fees hold significant importance over time. Consider this. You invest $10,000 in a fund charging 0.25% annually. That's $25 per year before price changes. As your investment grows, fees rise too. Savvy investors look beyond low share prices. They consider expense ratios, fund structure, and total cost. Now for a tricky question. If Bitcoin goes up 20%, does your ETF follow? Not necessarily. Your Bitcoin ETF might perform differently due to expenses, trading costs, or valuation differences. So, always evaluate an ETF's performance relative to its benchmark. Tracking is crucial. Finally, a hidden issue for Canadians: currency. Bitcoin prices are often quoted in US dollars, but you invest in Canadian dollars. Currency movements can affect your return. If Bitcoin rises, but the Canadian dollar fluctuates significantly, your returns in Canadian dollars could differ from those in US dollars. That's where currency hedging matters. By understanding these elements, you'll be better equipped to navigate the world of Bitcoin ETFs. Ready to take the next step? Dive deeper into the world of ETFs and explore which investments align with your financial goals.